Want to welcome everyone. Also, as I want to echo Kendall's thank yous to Liz and the leadership at Sherman, Long Island. So my name is Alan Pfeffer from Sentinel Benefits Group. With me today, my friend and colleague, Scott Riordan. Scott heads up our health and welfare administrative practice. Most folks, I think, at SHRM think of us as retirement plan experts, but we are, hopefully you think of us that way, but we're also very much experts in the health and welfare field as well. We don't conflict with Hub, we partner with Hub. And what I mean by that is that Scott's group is administering FSA, HSA, HRA, and COBRA plans. And we'll be touching on some of those topics today. As Kendall mentioned, this presentation is, the title is What's Expired, What's Here to Stay. But in doing that and saying that, Scott is going to touch upon elements of the CARES Act, the Consolidated Appropriations Act, the American Rescue Act, and the EPSO Disaster Relief Act. So my hat's off to the HR community and to Scott, who has to keep track of all this, all this legislation. Just one change, I think, to what Kendall said. Scott and I would very much like to have this be interactive. So if you would like to ask questions, please do so. We don't have to wait to the end of the presentation. You can do that as we go through the presentation by using the Q&A feature of Zoom, and I'll be monitoring the Q&A feature, and I'll be making Scott aware of the questions that you pose. So please feel free to pose those questions. You've got a real expert today, a real great partner today. So with no further ado, let me turn it over to Scott Riordan.
Thank you, Alan. And it's my pleasure to be here today with everyone. Thanks for your time. Thanks for tuning in. As mentioned, the focus of today's discussion is around legislation that came about in 2020 and 2021 in response to COVID-19 related to health and welfare plans. And as Alan mentioned, my focus and my specialty is in the pre-tax account space, FSAs, HSAs, and also in continuation coverage, also known as COBRA. So that's where I'll focus my time today and my energy. And the goal of today is to alleviate any confusion that might be out there. Acronyms aside, there's a whole set of confusion just in the acronyms alone, so we'll try to clear those up. But throughout COVID, throughout 2020 and 2021, there were a number of different pieces of legislation introduced to try to help people, access their plans. During that period of time, folks weren't going to the doctor, weren't going to the dentist, weren't getting elective work done. And related to pre-tax accounts specifically, it led to a buildup of balances. So the government did react to that, and they did try to help out folks by extending periods of time when you could access your funds, extending periods of time where you could actually, tap into dollars and carry them over. And there were a number of significant pieces of legislation in this world alone. And the legislation you see listed in that table on the screen touched on a variety of different topics in the HR and benefits world. But again, today the focus will be on the pre-tax accounts, FSA, HSA, and also the COBRA side. And we're going to talk about some of the legislation that came and went, some of the legislation that was allowed to stay, and a significant piece of legislation that will actually be ending soon. So the timing of this discussion is very appropriate because there'll be potentially some action required for employers, maybe administrators who you partner with in terms of communication, maybe some plan document updates. And I'll get into that at the end of today's presentation. So the purpose of today is first and foremost, alleviate confusion around what options are still available to you and what options are not. And then second to that, we'll get into some potential updates that you might need to make to your plan document. And then lastly, we'll touch on the EPSA disaster relief notices, as that is the piece of legislation that will be ending after the 3-year period where it was in effect. So with that, I'll jump in. And we're going to start with a few pieces of legislation that are no longer available. But the purpose of this is, again, to make sure that you're aware of what was once allowed, but is no longer, and therefore you can communicate this directly to your plan participants. At the end of 2020, a significant piece of legislation came out in the form of the Consolidated Appropriations Act, otherwise known as the CAA, the first acronym of many today. And the CAA, among other things, but related to FSA plans, allowed for some very significant flexibility when it came to the extended use of funds. And if you refer to the first two items on the screen there, what it allowed for was either a full carryover of health and dependent care funds or an extension of what's known as the grace period. And a grace period is a period of time after your plan year ends, which is typically 2.5 months, where you can actually continue to incur expenses and draw down off of a prior year balance. And what the CAA did was it allowed for that grace period to be extended from 2.5 months out to 12 months, or as I'd referenced, you can opt into a full carryover of health and dependent care funds. And these provisions were available for plan years ending in 2020 into 2021 and 2021 into 2022. But where the confusion comes into play is these were temporary. Employers did have to opt into them. Each of these provisions could be opted into individually, and even beyond adopting or opting into each of the provisions individually, you could even select them on a benefit by benefit basis to confuse things even further. So, you can understand how, I can certainly understand how HR professionals, benefit professionals, weren't crystal clear on what options are still available. And then to trickle down to employees, make sure that in tow, they also know what the options are that are available to them. So as of this point in time, the last point that the carryover option or the grace period option were available were for a plan year ending in 2022. This was a rare instance where the IRS allowed for these options to be adopted in the plan year following. But now that these options are no longer available, there really are no actions to take from an employer standpoint. But again, we thought it was prudent to point out the fact that these existed for a brief period of time because they were very impactful, they were widely adopted, and they were actually widely utilized. Because again, going back to the whole reason why a lot of this legislation was introduced was that folks could not access their funds to the extent that they had intended. And these extensions and these carryovers to a greater extent than normal allowed for folks to tap into their dollars for a longer period of time. Now, in a few slides, I will get into some more info on the FSA carryover, because the FSA carryover, to be crystal clear, still is available, but just in a more limited fashion. So we'll touch on that. But for now, know that no action is needed with respect to the Consolidated Appropriations Act for the FSA, but you did have those options available temporarily. Another acronym and another significant piece of legislation was ARPA, also known as the American Rescue Plan Act. Now, there were two provisions here that impacted the FSA and COBRA world. And the first was a temporary increase to the dependent care FSA maximum. Now, for those organizations, for those folks on the phone whose organizations offer an FSA, and if you offer a dependent care FSA, you probably know that the maximum contribution has been $5,000 forever. That amount was the limit when dependent care FSAs were introduced, and that amount is still the limit today, that $5,000 cap. And obviously, $5,000 does not go a super long way towards paying for daycare expenses. So what happened was, as part of this American Rescue Plan Act, there was a single calendar year period of time where an increased election amount could be offered. And that increased election amount or maximum was $10,500 for the 2021 calendar year. Now, this was confusing in a few ways because it was specifically tied to a calendar year. And many employers offer what we call an off-calendar plan year. So a plan that doesn't run from January to December. That created a lot of complexity for folks who wanted to contribute $10,500 in a 2021 calendar year where their plan year ran over into 2022, let's say. So it was not the most straightforward option. However, it did allow for more than double of what is normally allowed in dependent care FSA. Unfortunately, that option was only available for 2021. But a couple things I want to leave you with today is that there are actually groups, and Sentinel is part of a few groups who are lobbying in Washington for more broader access to some of these benefits. As an example, health savings accounts, or HSAs, are tied to enrollment in a high deductible health plan, and you can't contribute if you are enrolled in Medicare. There's groups lobbying in Washington to decouple HSAs from those restrictions, so you can contribute much like you can a retirement plan without having to be enrolled in any specific medical plan. But in addition to that, there is actually some groups, and there's actually been legislation introduced that would permanently increase the dependent care FSA maximum up to around 10,500. This provision is not yet passed. However, it's gaining some momentum because it would benefit a lot of American families if it did. Now, one more note on the dependent care FSA increase. If you offer an FSA and you offer dependent care, you may know that the dependent care benefit is subject to non-discrimination testing. And actually, your entire cafeteria plan and even your health FSA is technically subject to non-discrimination testing. But the dependent care FSA has a specific test. It's known as the 55% average benefits test. And it's the most commonly failed test among the Section 125 health FSA and dependent care non-discrimination tests. And the reason why it's most commonly failed is you as an organization can offer this benefit in a way that's completely fair. You offer it to any employee or any benefits eligible employee. You're offering it broadly in hopes that anyone takes advantage of it who would benefit from it. But unfortunately, the 55% test doesn't necessarily care about who you offer it to. It only looks at who utilizes the benefit. And unfortunately, it often works out that higher earners are the folks who take advantage of dependent care. And dependent care is a widely underutilized benefit to begin with. So what happens is these plans end up being very top heavy and fail the 55% test. The reason why I bring this up is I do see a future where there is potentially an increase to the dependent care FSA maximum, and probably a world where it's also indexed like 401k limits or like health FSA limits and HSA limits, where it'll actually keep up with the cost of living increases. But with that, there is also a movement to eliminate the 55% test, because you really can't have one without the other. Dependent care FSAs won't be utilized as widely as the IRS probably wants them to, and as widely certainly as us lobbying for it, would want to see if that testing or if those testing rules are still in place. So a lot to unpack there. Bottom line is this option was temporary as well, but want to make you aware that there's some movement on this front for the future, and you could potentially see a more permanent increase to dependent care down the road. The only other item of note with respect to the American Rescue Plan Act was that there was a 6-month period of time where someone could apply for COBRA subsidy if they were involuntarily terminated during a period of time prior to that. That provision is no longer available as well, but wanted to make you aware. So hopefully some good news in the future on the dependent care front, but no action needed at this time.
Scott, I've got 2 questions for you from the audience. First question is, even though these changes had a set end date, are the changes required to be included in the SMM to participants?
Yeah, they would have. There would have been an amendment, potentially an SMM or SPD update at that time. So if you adopted any of those provisions, you would want your plan documentation to reflect that.
Thanks, Scott. And then the second question is, are FSA account plan details always include a grace period for up to March 30th of the following year to submit claims for any remaining balance? The date was updated to 10/8/23 for 22 remaining account balances. Is this accurate, since I don't recall any notice of this for 22 FSA accounts?
The short answer to that question is yes, that is accurate. But I actually have that specific example. I promise that's not a plant question, right, Alan? So we have that exact scenario actually a little bit later in the presentation, and I'll be able to address that very scenario in a little bit more depth at that time.
Thanks, Scott.
Mm-hmm. Okay, so that was the legislation that came and went. Let's talk about a couple things that actually stayed, and legislation that you might be able to take advantage of if you have not done so already. So one of the first pieces of legislation that came out to address COVID was the CARES Act. This came out in March of 2020. And again, it had a lot of provisions in it and a lot that's related to the benefits world. But for our area of focus today, we're going to touch on the FSA update. And the major FSA update in the CARES Act was that it allowed for over-the-counter medicines and drugs to be once again eligible for an FSA or even for an HSA. To take you back a little bit further, as part of the Affordable Care Act, when that passed in 2011, it actually took out these products as FSA and HSA eligible. So they were eligible before 2011. As part of the Affordable Care Act, they became ineligible. And then with the CARES Act, they came back into play. And when we talk about over-the-counter medicines and drugs, we're really referring to things like pain relievers, allergy medicine, cold medicine. So, products that you can purchase over the counter that are medically related, but are considered a medicine or a drug. So for that, period of time from 2011 to 2020, you could only purchase things like bandages and first aid kits over the counter. But now with the reintroduction of this as eligible, once again, you can purchase medicines and drugs. And going back to the whole reason for this legislation, it goes back to being able to draw down off your balance. So because folks were not going to the doctor or dentist as much, not getting that elective surgery, they needed to find ways to help folks spend down their FSA balance. And this was one way to do it. Then about a year later in 2021, an IRS announcement came out that actually made PPE eligible in FSAs and HSAs as well. So that introduced a whole new set of expenses that were never allowed prior to COVID. So there is some potential action required here. If you offer an FSA plan, you hopefully have an FSA plan document. And oftentimes, just for the sake of clarity, the FSA is a component of your Section 125 or cafeteria plan document. So the cafeteria plan document, as you probably know, is what allows you to deduct money from your employees' paychecks on a pre-tax basis to be able, so they can pay for medical insurance, dental insurance, et cetera. That's the purpose of the Section 125 or cafeteria plan. The FSA, the health FSA, and dependent care, sometimes even the HSA, are simply components of that Section 125 plan. So just know that when we say FSA plan document, it really could mean FSA plan document, cafeteria plan, or Section 125. But the reason why we bring it up is it's possible that you do have to update that plan document and amend it to change the definition of what's eligible. As an example, Sentinel's plan documents that we provide to our client group had a different definition of what's eligible, and it referenced the fact that medicines and drugs you could purchase over the counter were not eligible. So we actually had to go out to our client base, had to amend the plan document, provide an SMM, and make those updates. So you want to definitely check that plan document and make sure that language references the most up-to-date version of what's eligible. Another piece of legislation that's here to stay is related to the carryover provision for health FSA. Now, at the very beginning, we talked about the Consolidated Appropriations Act. And the Consolidated Appropriations Act was that period of time, or related to FSAs, allowed for that 2-year period of time where you could carry forward your full FSA balance for both health and dependent care. Unfortunately, that didn't stay. And FSAs historically had been, or have been, a use it or lose it benefit. However, in 2013, a carryover provision was introduced. And what it said was that you could carry over up to $500 from one year to the next, though it did have to be adopted by the plan. And from 2013 to 2020, it really stayed at that $500 amount. Well, another IRS notice, another piece of legislation changed that fact. So notice 2020-33 came out in 2020. And what it said was that at the time, the new maximum went from $500 to $550. So we saw a $50 increase. On top of that, it also said that this amount would be indexed with cost of living adjustments. So it was not just set at $550 for the foreseeable future. It would be adjusted and potentially raised with cost of living. And the way that it works is it's always going to sit as 20% of the contribution maximum for the year. So for example, for 2023, the contribution maximum, the most you can put into a healthcare FSA is $3,050, 3050. So 20% of that is $610. So now 610 is the new carryover maximum for a health FSA for the 2023 year. So there could be some action required here. If your organization offers an FSA and you don't have the carryover provision, I would highly recommend it, because it takes away the fear of the use it or lose it. So if you have an employee who's on the fence about an FSA, if you offer the carryover provision, they can safely put in the $500, $600 and know that they won't use it. It'll carry forward to the next year. The second piece of it is you don't take on any more risk as an employer or as an organization, because these are benefits that the individual has already funded. So when they carry it over from one year to the next, you're not on the hook. You're not at any more risk than you already are for a health FSA, because they've already completely funded the account. So it's definitely in your best interest, I think, to adopt this as a planned provision. But second to that, if you have the carryover today, you do want to make sure that within your plan document, it references the index limit and it's not capped at $500. So when in our book of business with our documents, because the carryover limit had always been flat at 500, that's where the documents referenced. Now going forward, they reference the fact that this amount will automatically update with cost of living adjustments. And that way, your amount bumps up anytime the IRS bumps up that contribution limit, and no need to amend the plan or take action on a year-to-year basis. So again, definitely, I think in your best interest to offer this provision if you don't today. And then second to that, just make sure that the language related to the carryover provision speaks to the fact that it'll update automatically. Okay. So now we're going to shift gears and talk about the legislation that will be coming to an end within a few short months, actually less than 2 months' time. And what we're talking about are EBSA disaster relief notices 2020-01 and 2021-01. So the first disaster relief notice came out in April of 2020. And the idea behind it was that it allowed for extended period of times for certain actions related to benefit plans. And the scope of it covered HIPAA special enrollment events, COBRA events, and claim filing. And by claim filing, I'm referencing both claim filing deadlines and also your deadline to appeal a denied claim. So for the focus of, again, this discussion today, because of where our expertise falls, we're going to focus really on the COBRA and claim filing piece, but a little bit more on what this is first. So when it came out, this rule said that certain timelines are going to be extended until the end of the national emergency. So the national emergency started on March 1st, 2020, and it said that these timelines were going to be extended indefinitely until the end of the national emergency, plus an additional 60 days. And they called that additional 60 days the end of the outbreak period. So you have kind of two terms in there. You have the national emergency, and then you have the outbreak period. And the national emergency did not have a defined end date because we were very much in a national emergency. But 60 days after it was declared over would be the end of the outbreak period. And at the outset of this, that was the extended period of time. So if you think about it, and we'll get into some of the examples, but a COBRA election was one of the things that was extended. And at the time that this was first issued, it was possible that the extension went on multiple years because it was not defined at that point in time. So a little bit nerve-wracking for employers and administrators because of the ambiguity of it. Thankfully, in 2021, we got some clarity, and the clarity came in the form of the second disaster relief notice, 2021-01. And what this said was that the extension that were granted in the year prior did in fact have an end date. And what it said was that none of the deadlines that were extended out could be extended out more than 12 months. So while it did provide significant extended period of time, an extra year, there was at least an end date that was associated with it. So it didn't extend out in perpetuity. So let's get into a little bit more about what types of actions and what types of plans we're talking about here. So as I referenced, the big three buckets that were referenced in the relief notices were HIPAA special enrollment, COBRA, and claim filing for ERISA plans. So what that meant was, from a COBRA perspective, your period of time to elect COBRA, which is typically 60 days, was essentially extended out to a year plus 60 days. And the same would go for making COBRA payments for your initial payment and for your monthly payment to keep your COBRA coverage. From a claim filing perspective, we're talking about, again, ERISA plans. So health FSA and HRA would fit into that bucket. What you can see on the right side of the screen, what's not included in this were dependent care FSAs. So you even had some a lack of sync in between the two different benefit plans, even just within an FSA, in terms of what was extended out and what wasn't. And these were extensions that were not something you as an employer could opt in or out of. These were required. These were applicable, whether we liked it or not. So from an FSA standpoint, a health FSA and an HRA were automatically extended from a claim filing standpoint. And just a quick note on that. So when we say claim filing, we don't mean the period of time where you can continue to incur expenses. So what we're talking about is what we use in the industry as a term called the run-out period. And the run-out period is a period of time after your plan year ends where you can submit expenses that were incurred in the plan year prior. A very common example, many FSA plans operate on a calendar year, and that plan year running from January 1 to December 31 will have a run-out period that is most commonly 90 days. So that means you can submit your claims through March 31st of the following year for that prior calendar year when you incurred those expenses. So just to be crystal clear, what's been extended here was not your time frame or not an FSA participant's time frame to use money or to incur new expenses, but really just to submit those claims. Let's look at a visual to maybe send the point home as to what these extensions meant. So you can look at this in really two different ways here, because it has to be broad enough to capture both an FSA and a COBRA situation. So as an example for the FSA, if we're saying a plan year begins on January 1st, and that plan year ends on December 31st, in the normal course of business and normal times, that run-out period would have started that very next day. However, because of the extensions, that run-out period did not start for a full 365 days. So if you have a 2021 plan year that ends on December 31st, 2021, and in most cases, that plan run-out period would start on January 1st, 2022. It actually didn't. It actually started on January 1st, 2023. So it gave individuals an extra year to submit their claims. And then going to the COBRA example, again, it gave folks an extra year to elect COBRA, make COBRA payments, et cetera. So very, very wide sweeping and extended out for a long period of time. Well, the good news, while this did benefit some people, certainly, the intention of it, I think, was to try to be helpful to Americans, to give individuals just some grace, just some relief. And I think the intention of it was certainly a positive one. But in many ways, this was not a completely well thought out piece of legislation, because it created a lot of confusion. And from what we saw from our perspective, it really wasn't widely utilized. So it was something that employers had to abide by, and really wasn't something that amounted to much in the end. So the good news is we're returning to normality. We're returning to normalcy, and these are coming to an end relatively soon. So back in January, the White House released a statement saying that the national emergency, after more than 3 years, will be coming to an end. And the end date is May 11th, 2023. So if you remember back a few slides ago, I mentioned that we had kind of two terms, the national emergency and the outbreak period. And the outbreak period was going to end 60 days after the end of the national emergency. So now we have the national emergency with a set end date of May 11th, 2023, and 60 days following that will be July 10th, 2023. So what this means is, after that point in time, really after that second date, the July 10th date, the normal timeframes will come back into play. Your normal time frame to elect COBRA, 60 days. Your normal time frame to pay for COBRA, 30 days. And your normal claim filing period, however it's defined by your plan, comes back into play. So as of July 10th, we'll finally start to see some more normal timeframes back in the mix. I have a few examples here. The very first one is related to an FSA claim, and it's actually the same as the example that Alan asked from the chat or from the Q&A. So I'll go through it because I think it'll help paint the picture for some folks who might have this scenario. So we have a health FSA plan year that runs on a calendar year basis from January 1 to 12/31. And as I mentioned, most plan years have a run-out period of 90 days. While that's not necessary or not what it has to be, most plan years end up with that type of run-out period. So that would mean in normal times that as of January 1st, 2023, my run-out period starts, and I have until March 31st to submit my claims. However, because of the legislation that we're talking about, this was actually suspended until either the end of the outbreak period or the 12-month period that was capped at was up. So because of the fact that this year is going to fall into some middle ground, the way it's going to work is the run-out period that would normally have ended on March 31st, 2023 will actually kick in on July 11th, 2023, because it was suspended until the end of that outbreak period. So in this example, which I think is a common one, the run-out period will actually start on that July 11th date, and the 90 days or whatever it may be for your plan will start as of that point in time. So in this example, that would allow folks to submit claims through October 9th. So this year is definitely going to be an odd one, because if you look back to a prior year, you had that 12-month extension. And if you look to a future year, it'll go back to the normal 90 days or whatever your plan defines. But for this year specifically, you might have some nuance. And the idea is to know where your plan runout falls. And if it falls before the end of the outbreak period, it'll actually begin as of that July 11th date, the end of the outbreak period. We have a couple examples up there from a COBRA perspective as well. One would be a COBRA event happening before May 11th. So in this example, it's a May 1st election notice event date. And what it's saying is that because of the way that it falls, the individual have, in that example, until September 8th to make their COBRA election. And it's the same reason as actually the FSA claim. It's going to be 60 days in this case after the end of the outbreak period. However, after that outbreak period ends, again, we go back to normal timeframes, and it's just going to be the normal 60 days to elect COBRA, and the extensions will cease to exist. So in summary, I want to leave you with just some clarity here and then a few takeaways. What's happening here is after this 3 years of the national emergency, the deadlines are finally returning to normal, and it could require some updates to communications. And I'll touch on that in closing in a moment. But the good news is that really after July 11th, anything that happens after that point in time, a run-out period that was set to begin, a COBRA election, a COBRA offering, a COBRA payment, those all will return to their normal timeframes, 60 days for the election, 30 days for the payment, and then whatever your run-out period is for your plan. So we're finally hitting a point where we're going to see these extensions come to an end. So a couple actions that are suggested. The first is that if you offer a health FSA or an HRA, you do want to communicate the claim filing deadline to your plan participants. So the extensions potentially will exist for maybe the run-out period that you're in now. In using that example from a 2022 plan year, you might have an extension until October, whether that's when the run-out period will end. But the point is you want to make your plan participants aware of whatever your deadline is for your health FSA and HRA plan. From a COBRA perspective, you want to make sure that COBRA members, people who are either pending or have elected coverage, understand that the extensions are coming to an end and understand the correct timeframes to make their elections and make payments. And then lastly, you want to make sure that COBRA materials for new qualified beneficiaries are referencing the correct dates. So if you handle COBRA in-house, you have probably a set template that you use to make that offering, or maybe you outsource COBRA to a vendor. you want to make sure that the normal timeframes are going to be referenced once the national emergency and really the outbreak period comes to an end. So right now we're in a little bit of a middle ground as we approach the end date, but soon you want to make sure that those materials are updated. So no specific action besides really communication. But thinking back to some of the other options that we referenced before, it could also mean some plan document updates, but specifically to the disaster relief notices, it's really all about that communication.
Scott, a couple of questions came in. Just
Yeah,
tell me if we covered that or not.
yeah.
I want to just make sure I cover it. Um, question tied to slide 14. Are we legally obligated to send out communications to plan participants and/or COBRA participants?
There's actually no legal obligation. So the IRS and DOL suggested it, but did not require it, to be clear.
Okay. And then next question, and this is tied to slide 7, is the carryover option available for both health and dependent care FSAs?
Unfortunately, it's only available for the health FSA. For dependent care, the IRS does not allow a carryover option. They only allow a grace period, which, as a reminder, a grace period is an extended 2.5 months where you can continue to incur expenses against your prior year balance. So that grace period is allowed for dependent care, but not a carryover. So the carryover is only applicable to the health FSA.
And last question regards slide 4. If my plan has an off calendar year plan year, is it possible that the full carryover option is still in effect?
Unfortunately, no, because it's a plan year that the last time it applied was for a plan year ending in 2021, moving into a plan year that ended in 2022. So right now we're in the plan year following. So unfortunately, even for off calendars, those full carryovers are no longer available. Wish they were.
Thank you.
Mhm.
Right, we have a couple, actually, I think we have a couple more.
Sure.
Is there a sample notice to communicate the updated 2022 deadline to our participants?
There's no, to my knowledge, the agencies didn't put out any sample notice. I'm sure, an FSA administrator, if you work with one, would be happy to provide one. That's something we're offering. And then the last thing I'll just note is, if you do have additional questions, if there was something that was not clear in this presentation or something you would like me to address after the fact, you can absolutely feel free to reach out to me directly. My email is noted there on the screen. It's also on our website if you don't get it now, but feel free to reach out to me directly. I am more than happy to answer any questions related to what we covered today.
And I think I know the answer to this question. I think I can answer this one. One question was, and I assume a lot of people have that same question. Can we make copies of the slides available to participants? And I think Kendall had said at the very beginning that we'd be happy to get the deck off to people that participated today. Scott, do you know if the EPS pay will be sunsetting in May for COVID-related quarantines?
That is not an item that I have a lot of information on, unfortunately, or a little bit outside my area of expertise. So it's something we can maybe tap someone else at Sentinel to follow up on.
Thanks, Scott. Appreciate it. Great job as usual. Thank you very, very much. The last thing I think we wanted to cover is just to talk about our next boot camp that's coming up May the 12th. We've talked a lot about in the past fiduciary obligations as it relates to qualified retirement plans, but we haven't really talked much about the fact that the same sort of fiduciary standards apply to health and welfare plans. It's not lost on anyone that's on this call that health and welfare plans are ERISA plans at the end of the day, and that same good governance that we apply to ERISA plans, ERISA qualified retirement plans, should also be applied to health and welfare plans. So myself and my colleague Greg Puig will be talking about um, fiduciary standards as it applies to health and welfare plans. And fortunately or unfortunately, the timing of this could be better because I've heard from several of my employee benefit audit friends at various CPA firms that the DOL um, is definitely interested in now auditing health and welfare plans. We had talked about that years ago. Eventually, one day the DOL is going to get around to auditing health and welfare plans. Well, apparently that day has arrived. Um, so we want to make sure that everyone knows what their obligations are with respect to health and welfare plans. So we'll be covering that at our next boot camp, and I certainly hope you can attend. I want to thank Scott for a great presentation. I want to thank Kendall for all of her help in putting this together. And lastly, not leastly, but lastly, want to thank Liz and uh, basically the leadership at Long Island SHRM for allowing us to present this information to you. As Scott said, please feel free to reach out. Um, you have his email address. If there's anything I can help you with, please feel free to reach out to me. And really want to thank everybody for being such a great audience this afternoon. Thank you very much.